that. If you'd have year in, year out, back-to-back seasons, you sort of it's pretty hard to get off that merry-go-round.
G'day and welcome to the Farms Advice podcast with your host, Jack Creswell. Whether you farm it, service it, or just love it, this podcast is for you. We'll bring you the techniques and technologies you can implement into your day straight from the leaders and innovators themselves. Spread the Farms Advice so that we can reach more farmers right across Australia. Follow us on all of your socials at Farms Advice, and let's get into this episode. Before we get started, just to let you know, this episode is intended to be general information only, as the host and the guest do not know your personal circumstances, so please go and talk to your own accountant or the team at Biofields to get the right information for your scenario. Let's get into this episode. Very good. Well, Scott Smith, thanks for coming into the Farms Advice studio, the virtual studio, but we've both got studios over in WA and here in Dubbo. You're coming into my studio the very first time. Hopefully get something pretty established here at home so the sound quality can be improved, but welcome back.
Thanks, Jack. Feel very privileged to be the first one in the new studio.
It'd be good. I'd be keen to invite a few people too for a few chats once it is actually up and running. I've cleaned out the laundry on the way through to the room. But no, that's all good. Scott, before we get into it, tell me, what's the landscape? What's farming looking like over in WA at the moment?
Yeah, so probably pretty mixed bag, really. Anyone who's in livestock, our sheep producers, obviously they're struggling a fair bit with a big dramatic decrease in sheep prices from last year. And yeah, across the state, very, very different rainfall. In general, production will be lower from the last couple of years. That northeastern wheat belt, really struggling with growing season rainfall. Their production's going to be well down. And then there's still some pockets that have picked up some decent rain at some good times. That will mean that their average is, or they're hitting average or above, or slightly above average. So yeah, it's going to be a really, really mixed bag. The last couple of seasons we've probably been pretty lucky over here, where most people across the state have had probably above average production. But it's going to be a really, really mixed bag this year. So
yeah, that's probably right across. I did an episode last week, I think. It's probably the southern guys and girls down there are going to be doing the heavy lifting for our output, especially for grain sector coming through, and then everyone's sort of getting painted with the same stick within livestock, aren't they?
Yeah, that's right. Yeah, fairly concerning with the with livestock over here. But look, I think there's always going to be a place for it, and yeah, so.
So, what do you want to speak about at the moment? What do you see being a pretty important topic to get out there?
Yeah, probably at the moment, I guess, just given that it's going to be a fairly wide variety in terms of production, but probably looking at the tax side of things, what we're seeing or what we foresee is that even though production might be well down on last year, tax is still going to be an issue. And the reason for that is really there's the end of temporary full expensing.
Yep.
So that was those depreciation measures that were brought in just, in October 2020, sort of after or when COVID was in, which a lot of people most of our clients have had a pretty big cushion from tax because of those, or certainly our large cropping clients have had a big cushion from tax because of those write-off rules. They came to an end at 30 June this year, so we're not going to have those write-offs again this year. So yeah, depreciation deductions are probably going to be a lot lower. And also on the flip side of that, if there's any trades or sales of plant equipment, that's going to add to their income this year as well. So a lot of those will have sort of a nil value from a tax point of view. So could be a bit of a double whammy from a tax perspective for the plant and equipment there. And also probably, we've had some pretty good production years over here. So a lot of people have deferred a lot of grain, either via cash contracts or deferred in pools. So we're sort of seeing, that a lot of grain's probably been deferred into July 2023, so it'll land in this financial year, really from that 2022 harvest.
Yep.
So even though sort of production this year might be well down, their taxable income is still going to be quite high. So with those deferred contracts and the amounts in pools. So not sure if you use pools over there, or pools are popular over in the eastern states there.
Yeah, they are pretty popular. There is a fair few like co-ops or like farmers within the region. They can hire out the silo that's not getting utilised by the companies themselves. And also, storage within the grain sites, receivable sites is pretty big, I suppose, for people if they think the price is going to rise or something. I actually can't remember what the grain prices were this time last year, but I'd imagine right now is a pretty good time to be selling off the back of what last year was, holding on to that. What's the advantages you see from the accountant's perspective of holding on to your grains rather like without looking at the cost increase or even decrease if you didn't time it too well and you need to get rid of it? What's advantages of holding that over into 23 sort of harvest season being old grain?
Yeah, so I guess there was probably two sides of it. Like we saw probably a bit of a resurgence in the use of pools over here. Probably the last couple of seasons where pools have sort of gone by the wayside when, single desk was abolished, more than 10 years ago. Hadn't really seen pools too much, but they really came back into vogue the last couple of seasons. One, from a tax point of view, sort of being able to defer that income. And two, there was often a big difference between the estimated pool return and the cash price on the day. So, it was purely from a profitability point of view that people were going to those pools, and that was just due to a lot of things, but probably one of the main things was sort of shipping capacity out of WA. But in terms of on the tax side of things, really trying to smooth those variations in income year in, year out. So we put a fair bit of time into making sure we're doing tax estimates and trying to take those big variabilities out, take out the big spikes. So trying to smooth your income across multiple years means that you're going to pay less tax overall because your income's not getting pushed into a high tax bracket in 1 year. So that's where it works, and pools were probably one of the tools that you could have used to do that. So
a bit like you're trimming the fat sort of thing. You want to bring it back down under a sort of threshold within the year. You don't want to pull it all together. You want to make some sort of cash flow there.
Yeah, that's right. And so sort of managing the cash flow as well. So you don't want to defer too much where you're starting to get up against, finance limits and things like that. So very conscious of cash flow limits when we're looking to defer grain. But just trying to manage those seasonal fluctuations in income, so that we're just trying to flatten it out. We use a pretty good graph where we drag up sort of the last 5 years of income averaging, because as you know, if you're a primary producer, you're averaged on, or you're taxed on your last 5 years of income if you're on the averaging system there. So if you've got a low year dropping off the end of your averaging history getting replaced by a higher one, your tax rates is sort of on the upward trend there. So we try and put a bit of science behind the tax planning there.
What about if you run into a few good years? I hope we do again. And you defer selling your grain again, or you don't. So like you're stuck with 2 seasons worth of grain. How do you sort of work with this when I know you may be under time sensitivity or a bit of pressure, cash flow pressure there to work that the best. Otherwise you're going to be left with a lump sum.
Yeah, so really probably a couple of things there. So we've probably had a couple of clients that were in that same boat where they just sort of got on a bit of a merry-go-round in terms of deferring of grain. And it is pretty hard to get off that. If you have year in, year out, back-to-back seasons, you sort of, it's pretty hard to get off that merry-go-round. Probably the last couple of years, certainly over here where production's been really good, we've had those depreciation write-offs. So people have really made use of good production years, utilize the depreciation write-offs, and it's probably taken a lot of pressure off having to defer so much grain.
Yep.
Had we not had those depreciation write-offs, there might have been a lot more grain deferred than what had happened already. But then you start looking at what other tools you've got in your tool belt there. So things like, whether FMDs, so the farm management deposits, whether they come into play. I think they've got a place for growers that are in a sort of a quite a variable production. So probably more your marginal country. That's where FMDs really come into their best use. Where they don't really work is where you've got pretty solid, rainfall and pretty solid production areas. The FMDs are easy to put in, but they're just hard to get out tax effectively when you just, constantly have those good levels of profit. So sort of really horses for courses there. Probably something we're seeing a little bit more of that we'll probably continue to see is the use of companies.
Yeah.
So either allocating to a company from a trust, or for those really high profitable businesses that are sort of constantly making those high profits. Whether you go to a trading company there.
What would be the pivotal point in that would you need a couple of run-on years to get that sort of clarity in thinking we need to go into a company sort of structure?
Yeah. I think probably the first step would be potentially starting to allocate some profit through to a company. And then with a view to longer term, maybe moving into that company as your trading company.
Yep.
If the subsequent seasons and production and profitability is maintained there. So it's certainly something we don't go into lightly. And it's not going to be suitable for every single client there.
Yep.
But for those high profitable clients that just have that constant high profit results, it can be quite effective.
It's a good one. I'm not sure if you touched on it, but superannuation, when you're having a good year, this is I like the thought of a bit of a backup for when you're older, and also building that nest egg. And also you can probably leverage off it in some ways or another. But how does that work in after we've had a good few years? We've had a good roll on all these episodes, and I was speaking about in our previous episode as well, Scott, about how well we are going, and that time is the perfect time to look for opportunities during these dry times. And now we're here. I hope a few listeners have sort of listened in, taken a few things away, and actually tried to start their estate planning, their succession, or look to put away a few dollars into superannuation, all under good guidance, of course. But how does super roll into this?
Yeah, so we see super as a pretty effective tool from 2 points of view. One, it's quite tax effective. Obviously, you can put some money into super, claim a tax deduction at the farm level, and only get taxed at 15% on the way into the fund. So you can save some tax on the way in. And also the other benefit that we see with super is building up that off-farm asset, really. So, for your longer term succession planning, really, and retirement planning, we see that it's quite useful. It's obviously really important to make sure that whatever you're invested in that super fund is appropriate, because you've got to make sure that based on your retirement timeline and your risk profile, really. So you really need the help of a financial planner to make those, or to make sure you're invested in the right things. But certainly from a tax and succession planning point of view, yeah, it works really well.
What are families doing over there? Are they expanding or are they sort of consolidating at the moment? Because like these sort of pressures on new and older farmers could send them out of business, and then that land's got to go somewhere.
Yeah, so there's still plenty of demand for farmland over here. Yeah, prices haven't really slowed down. A few people were saying that, you know, prices might sort of plateau for a while because there's been some pretty dramatic increases in farmland prices over here. So it'll be interesting to see if they start plateauing. From a succession and retirement point of view, a lot of our clients are, at one point, they might have sold the farm, and then, you know, look to make other off-farm investments, but now they're sort of keeping the farmland as part of their retirement. So they might be looking to move it to a super fund, or, you know, just retaining it and living off the lease proceeds. It's an asset they understand. It's performed well from a capital growth point of view, and it's giving them that revenue return. So it's sort of ticking all the boxes. So yeah, probably seeing them retain the farmland. Yeah, in terms of their retirement, not really seeing it sold in too many occasions there.
Yeah, because the value is always going to be carried through. Once you've got the farmland in your super, how does that sort of operate? Does it operate just as like cash assets?
Yeah, so really, if the farmland goes into your super fund, you really need to, if you're using it in your farm business, first of all, you need to pay a market value rent. So you need to pay a market value lease to the super fund, and that's whether you've had a poor year or an absolute bumper year. So that lease is payable to the super fund every year. Probably other. So it's a way to be it's a quite effective way to be able to boost up your super fund, because you can do your contributions each year, but you can also do a market value lease to the super fund each year as well. So you're sort of claiming a deduction at the farm level at, say, 30%, and that lease is getting taxed in the super fund at 15%. So you sort of, yeah, you can have a net sort of 15% tax saving in that scenario. One of the things to keep in mind, if you did move some land or bought some land in super, is you can't use it as security for bank borrowings.
Yeah, okay. Yeah.
So you sort of lose the ability to mortgage over that, and so it can potentially reduce your borrowing capacity if you are trying to buy more land and expand the farm. Yeah, it might not be the best option.
Yeah, I would have thought that you could leverage off it, but obviously not. What's the go with? Is it locked up until you're 65, or until they stop the retirement age going up? Or?
Yeah, that's the other thing with having it in the super fund, is it's fairly restrictive. Obviously you could sell it if you wanted to. But yeah, in terms of accessing those funds, you're not going to be able to access them until you're at retirement age. So that's probably another downside to you know, having that balance between, you don't want to put too much into super at a young age, because it's just locking those funds away for a very long period of time. That's where you sort of, yeah, make sure you have a balance between not wanting to put too much into super, but yeah, wanting to save some tax as well. So yeah, sort of depends what your goals are, what your age is. And
Are farmers putting in like parts of their land, partial? You can do that, or just
yeah. So we had a client that we did recently that yeah, they had some pretty significant growth in their farm values. And you're sort of getting restricted to how much you can put into super now. So you've always been restricted, but it's just getting harder to get funds into super. So we ended up actually transferring 20% of one of their blocks into the super fund. So we couldn't get the whole title in there because it was too much. We couldn't get the contributions and that in there on the super fund side of things. So that's one side. And the other side is probably the capital gains tax, because whenever you move that land, if you're moving it into super, yeah, you're going to trigger some capital gains tax on that land if it was a, you know, post September 1985 farm there. So yeah, there's
the transaction
What was that? Sorry.
Is that because the farmland going into your supers counted as a transaction?
Yeah. 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 So it triggers a capital gains tax event whenever you transfer that. So yeah, we've only done it where we've been able to access those the capital gains tax exemptions there.
Yep. So what are the capital gain tax exemptions available at the moment?
Yeah, so really there's some, when we're talking about those ones, that we're talking about the small business capital gains tax exemptions. So there's a couple of gateway tests. One is a $2 million turnover test. So that's if your farm income is less than $2 million. And the other is sort of a net asset test of under $6 million. So we're finding these harder and harder to access, really. And that's probably from a couple of reasons. One, as farm businesses have gotten bigger and bigger, that turnover has increased significantly. Where probably, 10 years ago, we might have had 80% of our clients might have qualified. Now it's probably the reverse. Now it's probably, 20% of our clients might qualify for those exemptions there. And particularly with the rapid growth of farmland too, there's not too many farms that are going to be under net assets of $6 million anymore.
Yeah, no, $6 million doesn't account for much these days, does it?
No. So it's sort of worthwhile if we can get those exemptions. It's almost like winning the lotto sometimes, because you can potentially save millions of dollars in capital gains tax sometimes if we're wanting to either sell the farm or move some land into a super fund or transfer the land from a succession point of view. Because there's still a lot of land that's owned in sort of mum and dad's personal names, that trying to get that to the next generation, usually into a land holding trust that's controlled by the next generation there. It's pretty handy to be able to access those concessions, but they're getting harder and harder to access just because of that increase in land values and the expansion of farm businesses over time.
These concessions, how, do they just be picked up naturally, automatically when you submit your BAS and then end of year tax return and tax planning on the ATO? How does that work? Or do we need to work with our accountants, be in their ear a bit more?
Yeah, you really need to work with your accountant on this one, because it's a really, those two tests are really sort of your gateway tests. And then there's a lot of rules after that. So that it's quite a complex area, and not every single scenario will qualify. So given the potential tax savings as well, you've really got to dot your I's and cross the T's with this one. So yeah, it's something that you've got to talk to your accountant about and get them to do some specific advice on that, because it's quite a niche or it's quite a technical area of tax as well. So you've got to make sure you do it right. And the thing with those concessions is it's a cliff face. So you're either in or you're out. So it might be a $1 million tax saving, or it might be a zero, you might be full tax. So it's really important to get that right. But having said that, if you can get those concessions, it can really open the door to doing succession planning and potentially, structuring your assets a bit more tax effectively there. So we're sort of seeing that, even though production might be down this year, it might be an opportunity to actually try and access some of these concessions. And, where your succession has actually might have stalled because, you're looking at a big capital gains tax bill. This might be an opportunity if your farm income has sort of dipped under that 2 million. Obviously, not everyone's going to be in that boat, but there might be some people in that boat where, their income's dipped under. It might be a sort of once-off opportunity to get the succession plan sort of moving or pulling the trigger on it. So
there's a lot of things that come into play, isn't there? And especially how this all sort of files into succession planning and looking at structures and the past conversations we've had on Beyond the Tax Return series. it sounds really simple when you hear about it, and then going away and actually putting pen to paper with your accountant and running through the right scenario for you and what works, what doesn't, and what's applicable at the time with the ATO, the government, what they're doing on their end, or even whatever they want, sort of thing, working with them and trying to get the most out of your farm business. From the accounting perspective, is it getting a lot more difficult to find these, not loopholes, but the strategies to maximize our gains?
Yeah, it's certainly been harder to access these concessions, and probably what we're seeing is it's almost stalling some succession plans, really.
Yeah.
So, like getting these, particularly the capital gains tax, like in WA, obviously the other thing to consider is stamp duty. So they're sort of your two main costs whenever you're moving farmland is your capital gains tax and your stamp duty. So in WA, like our stamp duty exemption rules for family farm transfers are pretty generous, really. Like we can generally access them, so we're usually not restricted on that side of things. Obviously, we still need to dot our I's and cross our T's with that one as well, but generally it's probably harder in general to access the capital gains tax exemptions than the stamp duty exemptions there. So
going into the end of the year, tax planning, we should always sort of look at what we're doing as producers. What's your take-home message from this episode for farmers to go away, get back into the office? Harvest is actually just around the corner. There may have been one or two even started further north in Queensland. I don't know about WA, but what's your message for everyone listening in?
yeah, probably having an idea of where you sit from a tax profit position. So that, like I said before, it's going to be a really mixed bag production wise, but it's also going to be a really mixed bag from a tax perspective too. So, for a lot of our clients, we do pre-harvest tax estimates. So when they first get the header in the paddock there, and they know, or they've got a good idea what yields are turning up, we can run some numbers, sort of see how it's stacking up, and that gives them a bit of an idea grain marketing wise. So that's going to be important for a lot of our clients that are having a half decent year with a significant amount of grain deferred from that 2022 harvest. It gives them a really good direction.
Can you start to plan for that, to know what your yield is, like going off by the eye as well, but on paper, when should you have that like in your office ready to go?
Yeah, so you can do it as early as you want, really, but probably we find you've got a lot more accurate data in terms of yield when you actually get the header in the paddock. Before that, you've got a bit of an idea, so but it's until you get the lie detector in the paddock there, you don't really know exactly how it's all tracking. So that sort of, we probably hold off until that point. Yeah, and then we can do a bit more of a reliable estimate in terms of income, and sort of seeing how everything's tracking there. And probably on the flip side of that is, if you are having a lower income year, it's always a good opportunity to potentially unwind some of those, tax deferral measures that you've put in place in previous years. So, things like squaring up your FMDs or, pulling them out, potentially drawing out some profits from those corporate beneficiary companies that you might have used to put some profit into, getting off the grain sort of deferral merry-go-round. And probably one that gets overlooked a little bit as well is probably family tax benefits. So if you've got a couple of kids and you've had a bit of a crook year on the farm, it might be a chance to actually access some of those family tax benefits there. So that can be quite valuable.
Well,
Yeah, and probably the big one, what we talked about before, is just those capital gains exemptions.
Yep.
Yeah, if your turnover does dip below 2 million, then that might be a chance. Might give you a bit of a window, which you've got a window in the current year and also the year following that year that your turnover dips under 2 mil. So you've got sort of a two-year window to potentially access those concessions there.
Yeah, so there's a bit to take away there. And imagine if you've got pen and paper, the notepad's full up to the brim at the moment. For the rest of 2023, what are you most excited about, Scott, for your clients? What are you optimistic about?
I really enjoy seeing what sort of tech they're getting involved in. So yeah, had a client the other day that's just bought one of those sort of green on green spraying add-ons for their boom spray, which the tech on that is pretty cool. And so stuff like your swarm bots, like your robotic sprayers. Just stuff like that. Yeah, that gets me pretty excited. Just seeing how clients have had a good year. Some of them obviously, that's not going to be across the board, but there's still plenty of positivity out there in ag, and plenty to be excited about.
I think this, the end of this year anyway, is about finding those 1%ers that don't cost you an arm and a leg. And I imagine people have got them pretty well established with their infrastructure off the back of spending what they earn in 2020, 21 anyway for that. So going into a bit of a drier time, hopefully you're a lot more established yourself and actually with a bit better mindset going into this, going into these times. But Scott, thanks for coming on to Beyond the Tax Return for another episode. I think this is your third in the hot seat now.
Yeah, it is. I'm chalking him up, Jack.
Yeah, we'll have to see how that how the tally's going for the most listeners in there. I think Jack Hayes was holding it before, so we might have to see if we can knock him off.
Yeah, got to get him off his pedestal.
That's it. So who can we expect to hear on Byfields next before the end of the year runs out?
Yeah, so I reckon next is going to be Jared Ryan, who's a manager in our agribusiness team in our Perth office here. So yeah, he'll be on next.
Beautiful. It'll be good to have him on. And how else can we get in touch with you? Do you have a direct line there, Scott, or is it best to go to the website?
Yeah, probably go to the website and then just call the Perth office if you want to get in touch with me. So yeah, more than happy to take anyone's calls or inquiries there.
Beautiful. I might even have a look at your resources on your website and add a few into the show notes there. I think it's always good to farmers. They can be pretty lazy, but laziness makes us a bit more creative as well. So I think it's a good thing. Scott, thanks for coming on to Farms Advice Podcast.
Thanks for having us, Jack.
This Farms Advice episode does not stop here. Come and join the conversation on Facebook, Twitter, Instagram, or TikTok, and even join our Facebook group. Go to farmsadvice.com.au for more on this episode and spread the hashtag FarmsAdvice to your mates. If you can leave a review on Apple or Spotify, that will let other farmers find us too. But until then, see you next Tuesday.